All right, it's time to let loose and talk about what we think is important in the world of finance. Joining me to do just that is Patty Edwards, Principal and Chief Investment Officer for Trutina Financial. Patty, welcome back. It's great to see you.
Always glad to be here.
So let's talk about the market here. It's gone up for 7 consecutive months without a pullback. We're starting to see some volatility kick up here on the back of what really looks to be a bear market in Japanese stocks and fears that perhaps the Fed might taper sooner than thought. Is it time to finally get cautious?
You know, we've had a little bit of a pullback with markets off roughly 4.5% or so from the highs. I honestly believe that we may be done with the pullback and that we're not going to get the huge pullback that everyone's been waiting for. I know a lot of my colleagues have said, oh, you know, we need to get 8, 10, maybe even 15%. But if you look at how this has played out, it's playing out a lot like some of the stealth rallies played out in the 1990s. And those just kept going and going. It wasn't a big 10% move in any one month. It was just a steady climb. And it really feels to me, especially with the jobs numbers that have come out, things are starting to look like they're going to just continue a nice slow pace of growth, and that could be supportive of this market.
So would you be buying the dips then? Or if you said it's going to just keep steadily moving upward, it's like the Energizer Bunny, right?
Yeah, and if you think about it, stocks have pulled back. Some of them have corrected a lot more than others. I mean, there are some names that we like that have pulled back 20%. That's an opportunity to get in, but you have to be very selective about where you go in. So yes, I was in the market buying this morning, nibbling here and there, not wholesale buying, but doing some purchasing.
Well, let's talk about the Fed, right? Because they've really built this rally. I think it's pretty obvious that the economy is not where it needs to be, yet asset prices are quite frothy, right? I liken it to a cup of cappuccino. You've got the market on the top, then you have the milk, the foamy part, which is sort of the froth that the Fed has built up through its stimulus. And then you've got the coffee, which is where the economy and the earnings are. So I've got to wonder whether the Fed is going to be forced to pull back on QE before the economy is ready because asset prices overheat.
Well, I think that may have been a little bit of what they've been doing over the past couple of weeks, where they kind of signaled that, gee, maybe we were getting a little bit overdone, but they're not going to pull back until they actually have seen solid employment gains. And so we're starting to see a little bit better pace, but it's going to take a long time to build things back. This recession, we lost something like 6.6% of the jobs that we had prior to the recession. By far the worst that we've seen in the last 6 recessions going back to the 1970s. And we're now at, I believe it's 63 months of trying to get back to peak employment levels that we had prior to this. We're nowhere near it. In fact, we're still at the level that was the worst point of the last recession. Mm-hmm. And so we're 63 months. We think there's probably another 2 or 3 years to get back to peak levels. Bernanke's not going to raise interest rates and let things start to go back up in any significant form until he's really certain that we've got this employment situation handled. Yeah, we're not there yet.
Well, I have to kind of question this whole idea of the wealth effect and whether it's working, right? Because yes, you've got stock prices going up, you've got home prices going up, and that's supposed to boost consumer confidence, which we have seen, and that in turn is supposed to get consumers to open up their pocketbooks. But I have to wonder, Patty, if that could get short-circuited if incomes don't increase, right? And then that comes back to business confidence and whether businesses have certainty about the outlook to hire. I mean, if they don't, are we just going to be stuck in this 2% malaise? You said it's at least 2-3 years to go.
Right. I do think that it is going to be kind of like driving on a road that's got a lot of potholes. There are going to be times where we're going to hit a pothole and it's not going to feel real good. But I don't think that we're going to have bad data that's going to be a cause for dismay, and I don't think we're going to have good enough data that it's cause for euphoria. I think that it's just going to continue to be a steady climb out of here, and I do think that we're going to start to get a little bit more certainty. We're going to start to get a little bit more confidence from the business sector as soon as we deal with, frankly, Obamacare. That is the number one thing that we're hearing from our business clients that's keeping them from hiring because they don't want to go over 50 people within their organization. And so if small business isn't growing and until they understand what this really looks like and tastes like and feels like for them, then it's going to be stalled out at least for the next 6 to probably 9 months.
So Patty, how are you positioning your portfolio here? It was really those dividend stocks that led for the first half of the year. We're starting to see a rotation into the more economically sensitive sectors. What's your sense for the second half of the year? You think cyclicals are going to lead?
Well, I think it's going to be a different rally than I think we've seen before. Would I be out buying steel stocks right now? Probably not. On the other hand, if you look at things like industrials, look at technology, both of those we think are offering productivity enhancements. So you don't have to hire those extra people if you're a business who's uncertain about things. You can just get another server or get another computer that will do something a little bit faster. So we're looking into technology. Like I said, some of the industrial plays. With housing being a little bit more firm, you can start looking into some of the plays that go into the housing industry. For example, there are companies out there, believe it or not, that do nothing much. Well, they do a few more things, but they focus on doing things like the meters that go onto new houses for electricity, or light poles for municipalities. As municipalities get firmer footing in terms of their tax base, you're going to start to see some of those plays do better. So those are the areas that we're hunting in.
And I also have my notes here. You like McDonald's, you like Schonberger, Intel, and Qualcomm. If you could just give maybe a one-sentence explanation as to why you like each of those.
Well, with McDonald's, it's all about innovation, and they are continually changing their menu up right now, and I think that is going to drive sales there. On Schonberger, they have been doing a lot of R&D internally, as well as buying opportunities, other companies that bring R&D into the oil service field. And because it's getting more and more difficult to get energy out of the earth, they're a nice one-stop shop for that going forward. On Intel and Qualcomm, there's a great statistic that we found. For every 500 smartphones that come online, it takes one server to take care of those smartphones. So given that, you not only are going to be needing more servers in the future, but you're also going to need more cell phones, smartphones. Qualcomm is the technology behind CDMA, which is the smartphone technology, and Intel is the leader in servers. And when you put those two together, we think you get a nice little pair trade out of it.
Interesting picks. Thanks so much, Patty. Always a good chat. Great to see you. We'll see you soon.
My pleasure.